Hey guys, Mike here. So today I'm going to give you an update on the margin debt indicator, which I told you I would. And also, I like to listen to people who actually have a pulse on what's going on Wall Street because they handle a lot of assets and stuff. And so none better than BlackRock, the guy we're going to hear from today. He manages 2.7 trillion in assets. So I think he knows a little bit what's going on and what, he obviously, one, doesn't agree with what the Fed's been doing, and he's also going to talk about, more importantly, what he thinks is going to come out tomorrow and give you a great example of, why they basically have totally missed their window, and it makes total sense. Plus, I'm going to listen to another person who's another very successful man in the investment community. And so, both of them make total sense. I couldn't agree more with them. Unfortunately, you saw, Wall Street sell off today. I don't think it had anything to do with what was coming out of the Fed meeting. I think it had to do, obviously, the bombing in Afghanistan. More troops lost their lives. So obviously, prayers and thoughts go out to those families. And what can you say about Afghanistan? I'm out of words. I don't know what to say about it anymore. So let's go ahead and get into what's going on with the margin debt indicator, and then we'll go ahead and listen to the guys from BlackRock and the other institution, okay? And so, of course, last time we talked about this, margin debt had pulled back just a little bit, but you can see, obviously, it has continued to pull back. And when you look at the past histories here, and we'll put this over the S&P in just a minute, usually you get a margin pullback, when the margin debt starts to decrease, it precedes a pullback in the market, whether that be just a small pullback, a large correction, or obviously the crashes you see right there. And so looking at this over the S&P, you can just see, obviously, if you can make that out, whenever it does a pullback like that, usually the market does sell off majority of the time. There are instances, though, which I'm highlighting here, to where actually there was a pullback and the market just kept going higher. And so as you can see up there, the S&P obviously is rocketing above margin debt as margin debt pulls back. And so it could be a sign of what is to come, since August, September is normally volatile anyway. And more importantly, as I've showed you guys before, 23.8% of pullbacks of 5% or more, or corrections, which are 10% or more, actually happened in October. And so, obviously we're at the end of August now, so that's only a month away. And so this could be, could be a sign of that. I personally think it's going to take, one more month on this chart to really, convince me of that. But, historically, yes, when margin debt starts to decrease and pull back, then that is usually a sign that the market's about to go into some kind of either sell-off correction, whether it be small, large, whatever it is. You can see by that chart. And so I wanted to update you on that. It's just something else to look out for, right? Nothing to be scared of, just something else to be aware of. But now what I'm going to do is go into, obviously tomorrow's a big day because the Fed's going to announce something, whether it be they are going to taper earlier than they thought, or they're going to wait till next year and just stick to their guns. And so listen to this guy from BlackRock. Like I said, he manages $2.7 trillion. BlackRock's the largest in the world. They got their CEO has a direct line into like the last 4 presidents, for God's sakes. The presidents call him for advice. So, the company's big time. So take a look at this guy, and he makes some really, really good points here.
In terms of rate hikes, though, Rick, what are you expecting there?
So listen, I think the Fed could have started tapering months ago. I think the whole discussion is, to me, is moot at this point. I mean, you just think about what we're talking about. We're talking 10 to 15 billion a month of taper. This week alone, we got, today we're going to get 60 billion 7-year notes issued. Yesterday, 60 billion 5 years. Tuesday, we got 60 billion 2 years. We're getting 30 billion equities a month. We're getting 30 billion loans a month. We're talking about 10 to 15 billion a month of treasuries. It's time to go. The liquidity is too big. So what does it mean for rates? Listen, I think they're going to de-link, and I think we're going to hear this from the chairman. I think they're going to de-link reducing the overstuffed liquidity in the system, but de-link it from rates. It doesn't mean anything, but I think what Jim Bullard said, that is right. It does give them a bit more optionality around rates. So you think about one thing that I think is critical. You've got an incredibly strong economy. You see some of these numbers that companies are printing, and it's durable. You see CapEx spend, R&D. If you don't start moving, you could start raising rates. The projection is you start raising rates in 2023. that's when we actually think the economy's not going to have this push to it of explosive hiring, tremendous capex, fiscal. They have
They're
some
missing the window,
fiscal.
so to speak.
Totally. It's just, it doesn't get started, provide some optionality, exactly what Jim said. And gosh, it would be a bad thing if you're starting to, you have to, or you've laid out a program where you're going to raise rates when the economy actually needs a little bit more of a monetary push.
What are the consequences then of waiting too long? I mean, from the stock market perspective, isn't that just a good thing if the Fed is delayed more and more? I mean,
so I don't think so. I mean,
okay.
No, I really don't think so.
And so hopefully that makes sense, and I agree with them 100%. I mean, they should have absolutely, at least the asset purchases, they should have been decreased that and tapered that off. Now, the interest rates are a whole different debate. As you saw in the video yesterday, which one did more damage to the market, the raising of the interest rates or the decrease of the asset purchases? I don't really know the answer to that, but interest rates tend to affect a whole lot more things out there. And plus, like you said, the liquidity is something we've probably never had this much liquidity in the market ever, right? I mean, and understand, I read today that, yes, even though the U.S. federal government is going to stop sending out stimulus checks, right, the states still have hundreds of billions of dollars sitting there waiting to go. The state of Florida right here just announced, I believe it was today, they're going to be sending out $1,000 stimulus checks to first responders and teachers and other people like that. And so that's more stimulus for, just millions going out into the market to be spent on goods and services or invested, either way you want to go. And so a lot of the states have that money just sitting there. And so the liquidity isn't the problem. And so I don't know why the hell they hadn't stopped the asset purchasing. I don't know. But this next guy really talks about that, and in particular about and the interest rate and what they're doing and how the Fed is manipulating the living hell out of the interest rates behind the scenes.
What do you make of what's transpired in the markets? What's your overall view?
So the 30-year Treasury bond got up to around 2.5% earlier this year, and now it seems like it can't get above 2%, even though inflation's been increasing. And that's one of the reasons why I say I think the Fed is behind the scenes trying to manipulate interest rates lower at the long end. So they've been extending the maturity of their quantitative easing, which is $80 billion of treasuries per month and $40 billion of mortgage-backed securities. And there's some whispering behind the scenes that maybe they're going to start thinking about tapering that quantitative easing. But as long as it's going on, they keep the bond yields at a very, very low level. I mean, we have negative real interest rates that are rivaling the Jimmy Carter era of the late 70s, with the CPI on the headline at about 5.4 and on the core at about 4.3. Either way you look at it, you're at -3 or -4% real interest rates. One of the things that I've been noticing for a decade now, even more than a decade, is that the stock market's market capitalization, let's just use the S&P 500. If you take that capitalization of the S&P and compare it to the size of the Fed's balance sheet, which is the consequence of their quantitative easing, which is now over $8 trillion. If you compare the capitalization of the S&P to the size of the Fed's balance sheet, it's almost a constant. And it's been that way with very little variation. It's almost like a law of physics, it feels like, market physics anyway. And so as long as the Fed is expanding its balance sheet, there's a tailwind behind the stock market. And so I think that's one of the reasons you're going to those new highs.
And I think he's right on. I mean, people keep wondering, how does the market keep setting, record highs like every week? We get a record high, we get a pullback, and then it shoots up the next day, we get another record, and it pulls back, we get another record. It just keeps melting higher because of all the liquidity and the fact there's still $120 billion every month being purchased in bonds and mortgage-backed securities. And so that's why you see real estate also continuing to drive higher, even though the amount of home sales are actually down. It's just one of those things that it can continue to melt up, but it can continue to grind higher and higher as long as those are in place. Now, even though you see consumer sentiment in the toilet, you see margin debt, like I just showed you, is pulling back and decreasing. A lot of people are heading into real estate and art, I even read, because that really doesn't lose its value, and gold. You get to the point where it don't make any sense sometimes, but that's just the market we're in now, right? And so we're going to see what they say tomorrow. Maybe they'll shock the living daylights out of it and say, oh, yeah, we're going to start tapering this year. But I would just be shocked, because you see a lot of his cohorts are already coming out saying we need to be tapering earlier, right? Well, what does that mean? Does that mean at the end of the year? Does that mean first quarter next year? That kind of stuff. So And then we got to figure out what's baked into the prices already, you know, because a lot of people are saying, well, it's already priced in, right? If they announce they're tapering, or it's already priced in. Okay, I mean, I don't know how that is, but maybe it is. We'll see. But you can see this market can swing on a dime, right? And so, plus we got to figure out what in the world we're going to do in Afghanistan. Are we going back in now? Is that what's going to happen? We're finna load troops and head right back over and start getting into that for, you know, another 20 years? Who knows? I don't know. You don't know. And so we're going to wait and see on that. I almost think that news has more to do than what's going to be happening tomorrow, but we'll see. Anyway, let me know your thoughts in the comments down there. Just want to put that out there to you guys. Hope you guys have a good night. And don't forget, use the link in the bottom if you want to account with BlockFi and get one of those credit cards and start earning some cryptocurrency, which is on fire right now. Glad to see that. Anyway, hope you guys have a great day, and I'll see you later.